Paying quarterly tax estimates is one of the most unnecessarily complicated areas of taxes, but it doesn't have to be that way. In this video, we're going to cover what are quarterly tax estimates, when should you be paying them, and how much do you pay. So let's jump in. So first, what are quarterly tax estimates? Quarterly tax estimates are just you prepaying the taxes that you think you might owe for the current tax year. Think of it like this. If you've got W-2 income, you get paid through a paycheck, you have all these things being deducted from your gross pay before you actually get your net pay. You have Social Security and Medicare being withheld, you have state taxes being withheld, you might have health insurance and some 401k stuff being withheld, but you also have federal income tax withholding. That federal income tax withholding goes towards the taxes you owe for the current year. So whenever you go to file your tax return, the taxes are calculated on what you owe, and you subtract out from that the amount that you've paid through your payroll withholding, specifically for federal income tax withholding. You can also subtract from that the amount that you've paid in quarterly estimated taxes. So it's essentially the same thing as paying your federal withholding on your paycheck, but you're doing it manually outside of payroll and you're sending the money directly to the IRS instead of having your employer do it for you. So now that you know what they are, when do we send those taxes to the government? Send them 4 times a year, that's why they're called quarterly, on April 15th, June 15th, September 15th, and January 15th. Now, if you'll notice, the dates kind of don't make sense. The April 15th payment is 15 days after the end of the quarter, March 31st. But the June 15th payment is actually before the end of the second quarter, and the September 15th payment is before the end of the third quarter, but then the January 15th payment is back to being after the end of the fourth quarter. I don't know why they did it this way, but that's the way it is. The important thing to know about your quarterly estimated taxes is that the IRS is assuming that your income is consistent all year long, and so they want to see those payments corresponding to the taxes that they think you're going to owe on that income all year long. So assuming that your income was consistent all year, if you go and make small quarterly payments for the first, second, and the third payment, but then catch everything up with your fourth quarterly estimated payment, you might have actually paid in enough in total to cover your taxes, but you could possibly still have underpayment penalties for not sending that money in throughout the year evenly. Now, you can actually have this work in your favor. If you have very, very seasonal income, let's say that you had low sales all year long, and then right in December, you had a massive Kickstarter. If you get that money before the end of the year, it's taxable in that year. But you can actually fill out Form 2210 whenever you file your taxes and tell the IRS, hey, I didn't have income consistently throughout the year. In fact, the majority of it came in the last quarter of the year. And so that's why I didn't make quarterly estimated payments evenly throughout the year. I only did it based on when the income arrived. And based on the numbers and based on the dates, you could reduce or possibly eliminate any underpayment penalties for not paying evenly. Now, if your income is only fluctuating the normal amount from month to month, season to season, then I don't know if I'd worry about doing the 2210 just because you might not be able to reduce or eliminate your penalty, if there even is one, by doing it. It's only going to make a difference if you had like a lot of income right towards the end of the year. Is way more than you had the rest of the year. One quick pro tip on timing your payments before we actually get to how to calculate the estimated payments. Whenever you make payments through W-2 withholding, no matter when those payments are made, they're assumed to have been made equally throughout the entire year. So if you do have a W-2 job and you do have the opportunity to change your withholding on your W-2 at any point during the year, then if you get towards the end of the year and you see that you're going to be short on your estimated payments, then you could actually make a larger estimated payment through your W-2 withholding at the end of the year, and it'll act as if you made that payment evenly throughout the whole year. Okay, so how much do you actually pay in quarterly estimates? And this is where I get so aggravated with how complicated this is, because this isn't something that only applies if you're like a $100 million business, and this isn't something that only applies if you're doing complicated things. The IRS expects everyone who might owe taxes, especially if you don't have like W-2 payroll withholding, expects everyone to do this, and they make it just more complicated than it needs to be. Here's what I mean. This is how the rule is written. Then I'm going to explain what it actually means. You're supposed to pay in the smaller of 90% of your current year tax liability or 100% of your prior tax liability if your adjusted gross income was less than $150,000, or 110% of your prior year tax liability if your adjusted gross income was more than $150,000. Does that make sense to you? Like, without having to go back and listen to it again and really think about it, does that make any kind of sense? No. So let me break it down to where it does make sense. You basically have two options. You can base your quarterly estimates based on current year's taxes or prior year's taxes, and it's a certain percentage of each one. It doesn't really matter which one you choose because the rule is written to say that you're safe from penalties if you've paid the lesser of or the smaller of those two numbers. Well, regardless of which one you do, you'll have at least paid the smaller of those two, because if you choose one and it ended up being the bigger number, then you paid at least as much as the smaller one. Does that make sense? It doesn't matter which one you choose for the safe harbor. Whichever one you choose is going to be at least the smaller of the two. So let's look at the current year first, because the math on that is a little bit easier actually. If you have paid in at least 90% of your current year tax liability through withholding and quarterly estimates, you get to consider both of those. It's not just one or the other. If you've paid in at least 90% of what you end up owing in the current year, then there will not be any underpayment penalties whenever you file your tax return. And you can probably see already what the issue is with this. During the year, you probably don't know what your current year tax liability is going to be. And so how do you know what 90% of it is going to be? Well, you could actually change your estimated payment every quarter based on your current year income and what you think your deductions are going to be. And you can basically calculate your tax projection every single quarter so that you're always at 90% of that. Or you could just use the prior year number since you already know what that is. When does it make sense to do the current year versus the prior year? It makes sense if you're making a lot of money and that 10% difference between paying 90% of current year or 100% of prior year really makes a big difference, and it's worth the time and money to accurately calculate your tax projection quarter after quarter. But for most people, we're just going to use the prior year number. If your income, if your adjusted gross income on your prior year tax return was less than $150,000, then you can use 100% of your tax liability from the previous year. Your tax liability is the taxes calculated before considering federal income tax withholding from your paychecks, quarterly estimated payments made, or refundable tax credits. If your income was above $150,000, then your estimated payments need to equal 110% of your prior year tax liability. So here's something that I want to point out real quick. Paying your quarterly estimates and meeting these safe harbors that avoid any underpayment penalties does not mean you won't owe taxes when you file your tax return. All it means is that you've paid at least enough to avoid penalties from the IRS for not paying enough, but you could still have a balance due when you file. How would that work? Well, if you're using the 90% of current year method and your taxes were $20,000, if you've paid in $18,000, then you've met that 90% safe harbor and you won't have any underpayment penalties, but you'll still owe another $2,000 to satisfy your tax liability. Or if you were using the 100% of prior year number and your tax liability increased a lot in the current year, then you still owe that difference. For example, if you owed $20,000 last year and so you paid $20,000 in quarterly estimates this year, but your tax liability this year was $30,000, you still owe the other $10,000. That doesn't go away. It's just that all you've done is avoided any tax penalties. Now, in practice, what does this look like and how do you actually prepare for paying your quarterly estimates? Well, you know, we like the profit first method, and so I recommend everyone sets aside 15% of their income before any expenses aside for taxes into a separate bank account. So if you bring in $10,000 before any other expenses, take $1,500 from that $10,000 and put it in a separate bank account called taxes. Do that all year long. If you've calculated your quarterly estimates based on prior year, then use that money that you've set aside to pay those quarterly estimates. If your income is going up throughout the year, then you're going to have the money you need to pay the difference in taxes whenever it's time. It's just that you've only sent the IRS as much as they require to avoid penalties, and you get to keep and earn interest on the rest of it in the meantime. So just a quick recap. Quarterly estimated taxes is you paying your federal income taxes in advance throughout the year. They're due on April 15th, June 15th, September 15th, and January 15th. And the simplest way to calculate them is using 100% of your tax liability from prior year if you're making less than $150,000 a year, or 110% of last year's tax liability if you're above that number. And remember, the amount that you're having withheld from paychecks goes towards that 100% or 90% or 110% in addition to the quarterly estimates that you're making. So don't go make 100% of quarterly estimated payments if you're already having things withheld from a paycheck or from a spouse's paycheck or anything like that, because all of your information is all going to be combined into one tax return at the end of the day where everything gets taxed together and all payments made get considered together in that as well. I hope that this was helpful. My goal is always to take these kinds of complicated things and make them easier to understand. So if this was confusing at all, please let me know and I'll do a better job of explaining it. If it was helpful, let me know that too so that I know that I'm on the right track. and I will see you next time.